Hello, everybody. It's Mike Preston at New Harbor Financial Group. It is Wednesday, February 21st, 2024. And this week, we want to talk about the psychological side of investing. It's really the hardest part about investing. I think it's a lot of what we have to offer for value is we can help filter out those emotions and the psychological aspect that people run into with investing. And so I'm going to go through the top reasons today, the top psychological factors that hurt people when it comes to their own investing. And we as professionals are really no exception to this. We're people too. We have a lot of years of experience and we've been hardened to this, but the things that we run into by and large over and over again are these 5 things that I'm going to go through in this video. So we'll try to keep it brief and we'll go through each of them and maybe provide an example or two about these psychological factors. So hopefully this will be some insight that you can use in your life and take action on. So by the way, please do subscribe to our channel at New Harbor Financial at YouTube and like this video. We're very grateful to have gained some more followers. A lot of people have been tuning into our videos, so thank you. Please do subscribe. So without further ado, the first one that I'd like to mention is looking too closely. I think that this is really hard. It's very hard. A lot of people look very, very closely at their account balance on an intraday basis, and it can get very emotional, particularly if you have a large account. If you have a large net worth, a 1% move can be tens of thousands of dollars in either direction. And it's just really noise. You really need to back up and tune out. And so whatever that means for you, you can craft a diversified plan. For the long term, you can index. A lot of people have done that. I wouldn't necessarily say that now's the right time to passively index, or you can actively manage your accounts yourself, or you can delegate to a manager like us. But no matter what you do, once you make that decision, give it some time to work. Don't hyper focus on it. I really think that when you hyper focus on something, it kind of takes away from your enjoyment of the ride. It takes away your ability to reach your goals, and invariably you're going to end up making the wrong decision at the wrong time. You're going to end up selling at a low, or you're going to buy at a high. It's really difficult, particularly in the last 10 years when, in my opinion, our psychological aspects have been, I guess I'd say, taken advantage of by central bank money printing. The whole wealth effect has been to make us all feel wealthy, to make us all feel comfortable, to get us to buy things. And so therefore, if you're not doing that, you're left out. You feel like you're not part of the party. But absolutely do your best. Set a plan, no matter what it is. You may say, I'm just going to, put 30% stocks and 70% bonds, and I'm going to put that in my account, and I'm just going to let it sit there. Okay, well, once you made a decision, and by the way, that allocation is probably fine. For now, I would say no more than 30% stocks in the very high elevated market that we have. But let's say that's what you decided to do. I think you can just leave it there. Leave it there for a year. Come back and look at it. That type of allocation isn't taking too much risk, and you don't need to play with it too much. Or let's say you've delegated to New Harbor or to another money manager, assuming that money manager sees things the way that you see things. Let that work. Don't look at it every day. Invariably, there's going to be some swings. Even our accounts have some swings of several percent in either direction, even though we have our eye on risk control. And certainly today, especially today, we have concerns about crash and crash protection. But whether you're doing something yourself or you're delegating it, or even if you decide to sit in treasury bills for now, like a lot of people have, just tune out for a little while. This market cycle that we're in is, in my opinion, a very large market cycle, one of what would be called grand super cycle degree. If you happen to follow Elliott wave theory at all, that's what it would be called. But it should come of no surprise to anybody that we're in some different times here. We're in the crux of a fourth turning. And so when this market cycle turns, it's not going to be overnight. It's not going to be like the tech bubble, which fell and then was rescued almost vertically after that low, or the housing crash that essentially was rescued fairly vertically as well, or the COVID crash, which was the shortest recession, if you even want to call that we've ever seen. Our theory is that the central bank is going to run out of the ability to do that. And so the next move down should last a while. It should be an L-shaped move, down, sideways, versus V-shaped, down and straight back up. So you're not going to have to do anything immediately. So set your plan, sit back and let it work. The biggest risk is going to be buying too aggressively and too soon on the way down. The way that we're managing money here, we will layer into the market. We'll use options to sell premium, which has a way of bringing in income into the account and is a much more forgiving way to layer in. So that's number one. Don't look too closely. Number two, being afraid to sell losers. Most investors have what's called loss aversion. You don't want to buy something at $100 a share and sell it tomorrow at $95 a share. I don't either. The problem with that is it's going to keep you in some losers for a long time, sometimes forever. You can ride a stock all the way down to zero if that's what happens. Now, if it's part of a diversified plan and it's one of maybe 100 or 1,000 stocks, that's not going to hurt you too much because the gains from others will offset those by and large. Some people have had great success over a long period of time, maybe 50 years, by buying a bunch of stocks. And even though some of them maybe went to zero, a couple of those seeds that they planted grew into giant oak trees and dwarfed every other one. That can work, and that's okay. But in general, when you take too big of a position in one thing or one stock and don't have the ability to sell it on the way down, you're going to take a big loss at one point or another. Certainly we have seen this. I've been in this business a long time. I've seen a lot of people go through this. We've lived through 2 crashes already, and we've got a third one coming, I think. And so we've encountered all types of people throughout the years and with all kinds of stories. And certainly I've had some personal experience with this over the years and individual stocks and things like that. Thankfully, not in our managed model. Our managed model is very diversified and conservative, but the point is that it takes experience to learn. It takes experience to become hardened psychologically. It takes experience to not make these mistakes that I'm talking about here. So loss aversion is something that you really should think about before you get into a trade. Here's a weekly chart of Cisco Systems. I'd like to step through this. This is a weekly chart of Cisco, one of the 4 horsemen of tech back in the internet bubble in 1999. This is a stock that everyone had to own. I was pretty new in the business back then, but I remember it well. Everybody had to own Cisco Systems. And so the stock here on a weekly basis, I'm just going to step through this to show you what it looked like as we approach the top. Down here at the bottom of the screen, you can see 00. This is what it looked like leading into the high. So there was $82 a share. Now, was that the ultimate high? How would you know? As it turns out, that was the ultimate high. And this is the 50-week moving average, this red line. It came down, bounced off there, and then it went sideways for the rest of the year. It gave you the ability to get out of that stock with a nice bounce, but the problem is it never really got back to the old high. And this is called an anchoring effect or anchoring effect, where everyone says, you know what, if it just gets back to this level, I'll sell. Well, it never really does. And then it undercuts the 50-week moving average again. And as we completed the year 2000, going into 2001, it looked like a never-ending drop. At this point, we had lost over half the value of the stock. Now, certainly the stock went from 80 to 40. I'm not going to sell it here. It's down 50%. If it just bounces a little bit more, I'll sell it, a lot of people thought. Well, the bounce never came. Now we've gone from 40 to 20. We lost another 50% again. And this is where people kind of start getting sick of it and start to capitulate. Now, I know this is a pretty unique example because this was the tech crash, and that was a pretty extreme situation. But this situation went on and on and on. And here we are in 2001. We bounced off 15. We're going sideways at 15. Now we almost reached 10, and it feels like it must be over. But the market didn't bottom until 2002. So here we are in 2002, and now we go through 10. And this stock basically went down to almost $5 a share before it ultimately rebounded. And so this is 1, 2, 3 years. This is a lot of time to sit through. It would have been better to sell the stock somewhere, to liberate that cash and be able to use it somewhere else. And so this is a hard thing about anchoring and not. You have to have a plan. This is the point. You have to have a plan before you get into the position. particularly if that position is concentrated. Now, if Cisco is one of 100 stocks, it's probably not a problem. You don't have to worry about it. Don't have to tune in. But let's say you had 2 stocks or even worse, 1 stock. Let's say this is, you put all your money in here. And certainly we've seen people that have done this, not necessarily with Cisco, but with others. If you do that, you better have a plan about getting out. You better understand loss control, because otherwise you're going to sit with this for a long time. Now, some of these tech stocks never came back. If I fast forward, you'll see go all the way up to present day. In fact, I'll move this to a monthly chart. And you see that Cisco is now trading at about $48 a share. If I change this to max available and look at the time frame, you'll see that Cisco has still never gotten back to where it was at the peak in 2000. Interestingly, it was a great company back then at 2000, Cisco was, and guess what? It's still a great company today. In fact, the revenues are better, or stronger, larger today than they were back then. This is just an example of a good company, bad stock here. And if you didn't have a plan for risk control, you were in big trouble. So the whole thing is, don't anchor, don't wait for it to get back even. It's never going to get there sometimes. And you can never pick the exact top. You're always going to feel stupid if you hold yourself to that kind of standard. So hopefully that helped you think that through. All right. The next thing I'd like to talk about is lack of patience. It's really kind of the opposite. And I'm not really sure that it pays much to go through a chart example of this, but it's really hard. It's hard to cut losers short, but it's really very hard to let winners ride. On the flip side, the example I gave you earlier, where if you bought 100 stocks and a few of them went to zero, it's okay because your winners would outweigh your losers. Well, the truth is, if you have a diversified plan, you're not too over concentrated in one stock, and you have something that's working out. Let's say your stock doubles in a short period of time, a week, 2 weeks, a month. Don't necessarily sell it just because it's up. Now, I'm not saying don't take profits. Maybe trim some. If you have 200 shares, maybe sell 50 or 100 shares. Sell some on the way up. But let your winners run. Let them run and become big winners. It's really hard to do. It's hard for everybody, even professionals. So think about that. And by the way, if anyone wants to talk about any of these things and particular examples of them, we'd be happy to go through some examples and help you think these things through. Herd mentality. Herd mentality is another difficult one. Everyone wants to pile into artificial intelligence stocks right now. And it feels like a no-brainer, right? NVIDIA is up again 40% this year. In fact, they report earnings tonight. We'll see how that goes. There's a lot of other artificial intelligence stocks that have gone vertical. But we've also seen some really large pullbacks in these stocks. So they're incredibly volatile. If you follow the herd and you don't have a plan to get out, like I just talked about previously, you're going to make this classic psychological mistake. So don't follow the herd. Be different. Whatever you do, think it through. Whether you're investing yourself or whether you're hiring somebody like us, think it through and then let that plan work. Because after all, if you hire us, that's what you hire us to do. They're professionals, to absorb some of that psychology, that emotion, and to stick to a plan. Lastly, don't fall in love with any one company. Now, there's a lot of stories about how people have become rich, putting everything in one basket. Particularly where we stand now at what I think is probably the end of the largest bubble we'll ever see. There's monster gains in some stocks. If you happen to work for the right company, that's great. That's how certain people became the richest people in the world. They, have all of their eggs in one basket. Bill Gates with Microsoft or Elon Musk with Tesla. That's all wonderful. Those people put their entire life work into that company. It's no surprise that they have their entire net worth in that company. But for most people, that's too risky and it's not going to work that well. And it's going to put you in all the emotional traps that I talked about earlier: anchoring, holding on to losers, being fearful, not being able to sleep. So don't fall in love with a particular company. My best advice to you would be, if you were doing things on your own and you were investing in individual stocks, let's say, have some list of stocks. Decide beforehand what you're going to have, maybe 10 or 15 stocks. And then if you have one in there or two in there that are not performing well, don't be afraid to sell them. If you have some that are doing well, that may have doubled or tripled, You may take small gains in them. Don't be afraid to book some profits, but really don't be afraid to let the winners run. So I wouldn't say you automatically have to rebalance all the time to bring everything back to the same percentage. Let your good ideas run, cut your losers short. It's way easier said than done. Don't follow the herd. Just think completely differently than everyone else. In the short term, the herd is right. In the long term, the herd is often wrong. So the short term, the herd may push things much farther than you think. And if you happen to be in those stocks, great for you, and take some partial profits along the way. But long term, think for yourself, have a plan, delegate to professionals if you'd like, and even then don't tune in too closely. So hopefully that was helpful. These are some things that I've learned over a lifetime of doing this, and the best way to learn psychological mistakes is to make psychological mistakes. And I certainly have done that. And a lot of people that we know and clients and people we've talked to over the years have made these mistakes. Hopefully you won't make these mistakes, or if you have, you'll stop making these mistakes. As always, we're very happy to talk with anybody. Give us a call or click the address in the bio. In the details below the video, you can go ahead and click, send us an email. We offer a free consultation. Happy to do it at any time. For anybody, please reach out to us. We just want to help. We've learned a lot of things over the years and we want to help. And also, again, don't forget to subscribe to our channel. Our channel is growing and we're very grateful, and please like this video. So until next time, it's Mike Preston at New Harbor Financial. Thank you very much.